Is a stock that just plummeted 19% in a single day a massive value trap, or is it the ultimate undervalued buy for a daring investor?
Well, the answer to that is hiding in a very messy, highly volatile intersection of institutional trading data and, honestly, market psychology. I mean, the underlying mechanics of this specific drop tell a story that most retail investors are just completely misreading right now.
Yeah, that makes sense. Welcome to the Deep Dive, everyone. Today is Monday, April 20th, 2026, and the subject of our autopsy today is Eightco Holdings Inc. You probably know them by their ticker symbol, ORBS.
Right. ORBS.
Yeah, and they just closed today at exactly $0.99. So let's just call it 99 cents. That is a brutal 19.44% drop for the day.
It really is brutal.
So our mission here is to tear apart the financials, the technicals, and, the fierce debate around this highly volatile stock to see what's actually happening under the hood.
And looking under the hood is critical here because the surface-level metrics on ORBS are presenting this massive optical illusion to the broader market.
Oh, for sure. But before we rip into the balance sheet, just a quick reminder for you listening. Hit that like button, subscribe to our YouTube channel, and leave us your feedback in the comments. We've been told it's absolutely compulsory if you want the algorithm to spare you.
Yeah, you got to feed the algorithm.
Exactly. And remember, as always, we are dissecting market data for educational purposes today. We are not handing out financial advice. So let's establish the broader historical context of this price action first. I mean, a stock doesn't just organically land at 99 cents.
No, it definitely does not.
Right. So I'm looking at the 52-week range, and the low end is 74 cents. But the trailing 52-week high is an astronomical $83.12.
Yeah, $83 down to less than $1. I mean, the magnitude of that decline is precisely why the company, which, by the way, still holds a market cap of around $390.322 million, is commanding so much attention.
Wait. It's still worth almost $400 million?
Yep, even at 99 cents. And we are talking about daily volatility of 28.16% here.
That's insane.
It is. When a stock swings nearly 30% in a single trading session, you're no longer dealing with traditional valuation models. You're dealing with a highly emotional trading vehicle.
Which brings us to the beta. So the beta for ORBS is sitting somewhere between 2.95 and 6.58.
That's a massive range, yeah.
It is. Let's break the mechanics of that down for a second. So a beta of 1 means a stock moves in lockstep with the broader market, right? So if this thing is pushing a beta of 6.5, it's not just mirroring market chaos. With a beta that high, is this stock basically a magnifying glass for market chaos? Like, if the S&P 500 catches a mild cold, ORBS is effectively ending up in the intensive care unit.
That's a great way to put it. And the amplification works in both directions, which is the exact psychological snare that's catching traders right now. I mean, this extreme sensitivity to the market, combined with that catastrophic drop from $83, is why stock analysis platforms like Stockopedia, for example, have officially tagged ORBS with the sucker stock classification.
The sucker stock. Wow, that label feels a bit blunt.
It's very blunt, yeah.
But I guess I understand the behavioral economics behind it. A 52-week drop from $83 to under $1 isn't just a falling knife. It's like dropping a grand piano out of a skyscraper.
It really is.
And retail traders pull up the chart, they see a sub-dollar stock that used to trade in the 80s, and their brains immediately fall victim to anchoring bias.
Yes, exactly. Anchoring bias.
Right. They anchor their expectations to that $83 price tag, assuming a bounce back to even $10 or $20 is an inevitable law of gravity. And they just completely ignore the fundamental rot that drove it down to 99 cents to begin with.
Yeah, anchoring bias is arguably the most destructive force in retail trading. People assume a stock that has fallen 98% is just inherently cheap.
Right.
But mathematically, a stock that has fallen 98% is just a stock that fell 96% and then got cut in half again.
Oh, wow, when you put it like that.
Yeah, the historical price has zero gravitational pull on the current valuation if the underlying business model is fundamentally broken.
So let's look at that business model to figure out why the institutional market priced this from $83 down to a literal penny stock tier.
Let's do it.
Opening the income statement over the trailing 12 months, or TTTM, revenue is sitting at $32.98 million.
Okay, so they are generating some sales.
They are. But then you look at the net income, and it is a staggering negative $262.11 million.
Ouch.
Yeah. So they brought in about 33 million, but lost 262 million. Their profit margin is literally 0.00%.
Yeah, it's not a great look.
It's like running a lemonade stand where every $1 cup you sell costs you $8 to make. They aren't operating a business, they are operating a capital incinerator.
A capital incinerator is exactly what it is.
Yeah.
And the sheer scale of that cash burn is what drives the diluted earnings per share down to negative $4.14.
Right.
I mean, when your operating costs eclipse your revenue by a factor of 8, you have a structural failure in unit economics. Every single product or service they deliver is costing them exponentially more than the customer's paying.
Let's talk about the velocity of that burn rate, too, because looking at their cash flow, the levered free cash flow over the trailing 12 months is negative $177.94 million.
And that's a key metric.
Yeah, I want to emphasize the levered part of that metric for a second. Levered free cash flow is the cash remaining after a company has paid all its financial obligations, like, interest and operating expenses.
Right. It's the actual cash on hand.
Exactly. It's the true measure of money moving into, or in this case, violently out of, the corporate checking account.
And that negative $178 million outflow creates an immediate existential crisis when you cross-reference it with the balance sheet.
Oh, absolutely.
Because for the most recent quarter, they're reporting total cash of $58.5 million.
Wait. So they're burning $178 million a year, but they only have $58 million in the bank.
That is correct.
That math is terrifying. That's a ticking clock, giving them, perhaps 3 or 4 months of runway before the bank account hits zero.
Basically, yes.
But here is the anomaly that actually stopped me in my tracks when I was reading through the sources. Despite a horrific return on equity of negative 215.08%, their total debt-to-equity ratio is sitting at just 4.63%.
Yes.
How on earth is a company bleeding this much cash, not drowning in traditional bank loans?
Well, the low debt ratio is the cornerstone of that optical illusion I mentioned earlier.
Okay, break that down for me.
So if a distressed company is keeping the lights on without taking out massive commercial loans or issuing corporate bonds, they're utilizing the only other mechanism available to them.
Which is?
Equity dilution. They're continuously creating and selling new shares to the public market.
Oh, I see. So instead of taking out a mortgage from a bank, they're just slicing the company's equity pizza into thinner and thinner slices to sell to retail investors.
Exactly. The company gets the cash to pay this week's bills, but the original investors are left holding absolute crumbs. That mechanism is precisely why low debt in a distressed company can be a massive red flag, not a lifeline. I mean, a bank loan requires proof of future cash flows, right?
Right. The bank wants to know you can pay them back.
Exactly. But the retail equity market just requires a compelling enough narrative to convince people to buy the newly printed shares.
So the dilution acts as a hidden, continuous tax on the retail shareholder.
Yes. They aren't going to face foreclosure from a bank tomorrow, but they are entirely dependent on the market's willingness to absorb endless dilution.
Okay, so if the fundamental reality is a dumpster fire of cash burn and equity dilution, we really have to wonder who is actually on the other side of these trades. Let's look at the technical analysis to see how the market is processing this.
Good idea.
So the overall trend, both short-term and long-term, is completely shattered. The price is trapped underneath the 50-day simple moving average, which sits at $1.12.
And the 200-day simple moving average is towering way above them at $3.70.
Yeah, that's a huge gap.
It is. And keep in mind what a moving average actually represents in terms of human behavior. The 200-day SMA isn't just a line on a chart. It represents the psychological cost basis for investors who have been holding for the better part of a year.
Right, so when the price is at 99 cents, every single person who bought near that $3.70 average is sitting on massive unrealized losses.
Exactly. They are staring at their brokerage accounts, desperate to sell the moment the stock rallies enough to minimize their pain.
So that creates an invisible ceiling of intense sell pressure every time the stock tries to climb.
Which is exactly what the order flow data confirms. Yeah. Algorithmic sell signals were heavily triggered back at the $1.32 local top. Right now, the immediate support level is being tested between 96 cents and $1.01. So closing today at exactly 99 cents means ORBS is balancing right on the edge of the cliff.
If it breaks below 94 cents, is there a floor or is it a trapdoor to nowhere? Because the technical analysts are projecting a rapid slide to 90 cents.
It's pretty much a trapdoor. Dropping below 90 cents puts them in uncharted penny stock territory where institutional algorithms typically step away and pure retail fear takes over.
Yikes. On the upside, resistance sits at $1.06, $1.13, and $1.32. But let's look at the momentum indicators because they're not showing any signs of a turnaround.
No, they aren't.
The relative strength index, the 14-day RSI, is oscillating between 40.00 and 51.72.
Right. And an RSI hovering in the 40s means the stock is technically neutral, but leaning toward oversold.
But oversold is good, right? Like, it means a bounce is coming.
Not necessarily.
Oh,
Oversold doesn't mean a stock has to bounce. It simply measures the speed and magnitude of recent price changes. An asset can remain fundamentally oversold for months while the price continues to grind lower.
Man, that's brutal. And the MACD, the moving average convergence divergence, paints an even bleaker picture. It's sitting at negative 0.07.
Yeah, the MACD is flashing a glaring sell signal.
So to mechanically break that down for you listening, the MACD calculates the relationship between a short-term moving average and a long-term moving average. When the MACD prints a negative number, it mathematically proves that the short-term sell-off is accelerating faster than the long-term trend.
Basically, the floor is literally falling away faster than the foundation.
Exactly.
The path of least resistance is aggressively downward. When momentum indicators like the MACD flash a sell signal within an already established falling channel, it tells the institutional market that any short-term rally is likely a dead cat bounce.
A dead cat bounce, right? A temporary recovery driven by shorts taking profit, not genuine buying interest.
Precisely.
Which perfectly explains the analyst ratings. The consensus among Wall Street analysts is currently sell to hold. And finding a concrete one-year price target is virtually impossible right now.
Yeah, no one wants to touch it.
It's as if the major desks have just thrown their hands up, deemed the stock unanalyzable, and walked away.
Institutional analysts abhor a vacuum of predictability. ORBS right now is the definition of a black box.
Totally.
The company is trading below all major technical support bands. The short-term outlook is distinctly bearish, and they are burning cash at a terminal velocity. Analysts are refusing to issue price targets because any model they build is immediately invalidated by the company's unpredictable equity dilution.
So we have a company with catastrophic cash burn, a deeply bearish chart, relentless dilution, and intense daily volatility. This brings us to the ultimate debate dominating the trading forums right now.
Big question.
Yeah.
Yeah.
There are clearly people still executing massive buy orders on this stock. What are the two sides of the trade? Is ORBS an undervalued gem simply waiting for the right catalyst? Or is it the ultimate value trap?
Well, the bear case is textbook. It relies purely on the deteriorating fundamentals.
Yeah.
You have consistent downtrends and a market cap that, despite the sub-dollar share price, is arguably still overvalued relative to their massive negative earnings. But the most damning piece of evidence for the bear case is buried in the earnings quality data.
Oh, yeah. I saw this in the institutional notes. ORBS currently has a Sloan ratio in the top 10%.
Yes.
To me, that screams that their reported earnings are a mirage of paper accounting, completely disconnected from the actual cash sitting in the bank. Is that what's triggering the value trap warnings on the institutional side?
Absolutely. The Sloan ratio is one of the most powerful forensic accounting metrics available. It measures the volume of non-cash accruals sitting on a company's books relative to their total assets.
Okay, so how does that work in practice?
So under accrual accounting, a company can book revenue for a product they've delivered, even if the client hasn't actually paid the invoice yet.
So they can report millions in revenue on the income statement, making the company look viable, while their actual bank account remains totally empty.
Precisely. You can't pay your developers or your server costs with accounts receivable IOUs.
No, you definitely cannot.
Having a Sloan ratio in the top 10% of the market is a massive flashing red siren. It indicates that the quality of their earnings is exceptionally poor and heavily reliant on accounting adjustments rather than hard cash flow.
Wow.
When you combine high accruals with negative free cash flow, you have the exact anatomical structure of a value trap. It looks cheap fundamentally, but the fundamentals are largely an accounting illusion.
But, every trade requires a buyer. Let's stare into the bull case because there are some really significant counterindicators here.
There are, definitely.
First, despite the bleeding, we have moderate institutional ownership sitting around 47%. More importantly, the filings show positive insider buying over the last 6 months.
That's a huge point.
Right.
Mm.
Corporate executives are taking their own personal capital and buying shares of a falling company.
Insider buying is notoriously difficult to fake. Executives might sell stock for 100 different reasons,
Mm-hmm.
buying a house, paying taxes, diversifying.
Sure.
But they generally only buy stock on the open market for one reason. They believe the current price is a severe mispricing of future value.
And the future value they are betting on appears to be a massive bet the company's strategic pivot.
Yes, the pivot.
The source materials indicate Eightco Holdings is making a heavy transition toward AI and blockchain assets. Crucially, they are touting direct exposure to OpenAI.
Which is the magic word right now.
Exactly.
Hmm.
This is the crux of the debate. Are they just throwing AI and blockchain at the wall to see what sticks, or is this the lifeboat that fundamentally restructures their revenue and saves the company?
This touches on the mechanics of narrative economics. We're in a market environment where artificial intelligence is the most heavily capitalized narrative in the world.
Oh, without a doubt.
If a company with a small market cap of $398 million and a sub-dollar share price can successfully integrate into the AI infrastructure, specifically with OpenAI exposure, the speculative upside completely overrides the historical cash burn.
Because at that point, the stock stops trading on its trailing 12-month fundamentals, and it starts trading entirely on its speculative future multiplier.
Exactly. And the bull case relies heavily on market mechanics to drive that price action. Remember that high beta of 6.58 we talked about?
Yeah.
If Eightco announces a tangible revenue-generating partnership in the AI space, the stock won't just drift higher. It will violently reprice. Furthermore, a stock with this much downward momentum is inherently carrying a large number of short sellers.
Let's explain the short squeeze mechanics for a second for
Oh, sure.
listeners. When traders short a stock, they borrow shares and sell them, hoping to buy them back later at a cheaper price to pocket the difference, right?
Right.
But if a massive AI catalyst hits the wire, the stock price spikes. Suddenly, those short sellers are taking infinite risk.
And their brokerages will force them to buy shares at the open market price to cover their borrowed positions. This forced buying triggers a feedback loop.
Oh, right. The shorts buy to cover, which pushes the price higher, which forces more shorts to cover, driving the price even higher.
Exactly. The bull case argues that buying ORBS at 99 cents isn't an investment in their current financials. It's the purchase of a highly leveraged lottery ticket on an AI-driven short squeeze.
So the entire situation is just a high-stakes tug-of-war between forensic accounting reality and pure speculative potential.
That's the perfect summary.
You're either buying into the Sloan ratio data, which tells you the company is a decaying shell of accrual accounting, or you're buying into the AI narrative, betting that the technological pivot outpaces the bankruptcy clock.
And the distinction between being an undervalued asset and a value trap relies entirely on your timeline. Undervalued implies the core fundamentals are strong, they're generating real cash flow, but the broader market is just distracted.
Okay, and a value trap.
A value trap means the fundamentals are actively deteriorating, but the stock looks enticing simply because the share price has experienced a massive nominal drop. Fundamentally speaking, ORBS is exhibiting every single symptom of a value trap.
And the medium to long-term risk models reflect that grim reality, don't they?
They really do.
Predictive analysis suggests that if this AI and blockchain pivot fails to generate immediate verifiable revenue, the stock isn't going to just hover around $1. The models project ORBS could easily trade down between 36 cents and 85 cents over the next 3 months.
Which is terrifying because a drop to 36 cents from today's close represents another 60% destruction of shareholder wealth.
Wow.
The dilution required to fund their operations while they attempt to build out these AI assets will continuously suppress the share price unless the catalyst is truly extraordinary.
So what does this all mean for you listening right now? Let's recap the anatomy of this chaotic trade. We have Eightco Holdings, ticker ORBS, a stock that has collapsed from a 52-week high of $83.12 all the way down to a fragile 99 cents.
It's functionally incinerating capital, losing $262 million on a mere $33 million in revenue.
It is utilizing aggressive equity dilution to keep the lights on, masking its distress with a low debt-to-equity ratio.
Yet it retains an iron grip on institutional interest, bolstered by executives buying their own stock, and a narrative pivot into the two most explosive sectors of the modern economy, artificial intelligence and blockchain.
In the short term, the technicals show a stock trapped in a vicious falling channel, fighting tooth and nail to hold support at 96 cents. The long-term survival of this company rests entirely on a race against the clock. Can the revenue from their OpenAI exposure materialize before the $58 million in their bank account completely evaporates?
The market is basically standing on the sidelines, watching this asset fall, trying to figure out if it should run away from the impact zone or step in and try to catch it.
So we leave you with this final thought to analyze on your own. When a heavily shorted company is actively burning through its cash reserves, but successfully pivots to the most powerful technological trend of the decade, AI, at what specific point does the future potential mathematically outweigh the historical decay? Is ORBS a fundamentally misunderstood pioneer building the infrastructure of tomorrow, or is it just the ultimate retail trap using buzzwords to sell diluted shares? Dive into the data, look at the order flows, and let us know what you think in the comments. Thanks for joining us on this deep dive.